That is that capital that is required to run the business or to ensure that the working of the business is carried on smoothly. So that's the concept of working capital. Expression wise, if we have to put it, equation wise, if we have to put it, we call this working capital as the difference between current assets and current liabilities. And see, the study of working capital is important to understand that um, the short run position of the business is sound. So, for that purpose, the study of working capital is taken up, and overall about the liquidity position to test about its short term position, how good the business is in terms of making their payments promptly. This involves the concept of each of these current assets and the current liabilities, what role does it play, and what is the overall aspect about what is the operating cycle, etc. So all these things we would be looking into. See, multiple times in the class also I have mentioned about, see, what is the operating cycle. First, the amount of cash available is invested into raw material. Raw material gets converted into finished goods, and when these finished goods are sold, if they are sold on cash basis, the cash is received immediately, but otherwise it would be converted into receivables. The period would further get extended. At the end of the credit period, the amount is paid back. But here, then again, the way credit period is offered to the customers, they are allowed to pay after a while. So also the suppliers also in certain cases may give a credit facility. So cash is not immediately getting converted into raw materials, or cash is not invested into raw materials, but after a while, after the period is fulfilled, at that the end of the credit period, only the amount of cash goes to the supplier. So that is little extended, and then it comes into raw material. So nevertheless, whatever is that, shorter the cash operating cycle, it is better for the business, because whatever amount of investment which goes into the operating activity, it should get converted back into cash as quickly as possible. That's the whole concept of it. So we would calculate the value of cash operating cycle in terms of number of days. Number of days of cash operating cycle is calculated with the help of inventory days. We otherwise also in ratio analysis we have learned about it in MA, PM, etc. In those papers also it was learned as average collection period. Average collection period. How many days do the receivables um, take time to pay the amount? That is average collection period plus the number of days it requires for the. I'm really sorry about it. See, this is receivables, and the inventory part of it is how many days does it require for the inventory to be converted into cash. So we use certain terms like as inventory turnover ratio or stock holding period. So the turnover ratio, how many days does it require for the inventory to be converted into cash, stock holding period, etc. From this, the payables, just now we saw the facility extended by the suppliers. So the cash operating cycle doesn't start immediately, but it takes a little time, and then it starts because the supplier is also providing credit period. So minus, we see that it is payables days. So average payables period. Whenever we talk about these periods, it is basically about, in a year there are 360 days or 365 days, whatever is the case may be, divided by that respective turnover ratio. So that's the equation. If we are talking about average collection period would be 365 days divided by receivables turnover ratio. Stock holding period would be 365 days divided by inventory turnover ratio, stock turnover ratio. Average payment period is equal to 365 days divided by payables turnover ratio. So that is how we calculate these turnover ratios and then proceed further. So this is a simple concept about it. So let's, it is Instead of doing it as 365 days divided by a turnover ratio, the equations are given as directly 365 days into the denominator fraction is reversed, that is stock of raw material usage, or 365 days into work in progress divided by cost of, see, whatever is that, that is the denominator is reversed and taken into the numerator. We did solve a couple of questions from working capital management. Um, Here, I mean, in the class we've done. So overall part of it is grumpy company sales. I'll put this one on the screen. If you were present on that day when a specific question was done, so you let me know. We can skip that one and then focus on other questions. So grumpy company sells stress relieving toys and surprisingly perhaps is happy with its progress. With the progress it is making, I hope you're able to see it on the screen. Is making financially as it is
Yes,
growing,
ma'am.
and is it growing, it is growing and is profitable. There are issues, however, about cash flows. So we see that an extract from the accounting records for the most recent period um, is as follows. So there are details given about what are the credit sales, cash sales, receivables, other receivables, trade receivables, other receivables, credit purchases, cash purchases, trade payables, other payables, finished goods inventory at the start of the year and at the end of the year. Then, in one typical cycle of trade, goods were ordered on 17/1/15 and delivered 21 days later. The supplier was paid on 25/2/15. The goods remained in inventory for 62 days. So, focusing on the overall operating cycle, this question is framed. So, we are asked to calculate what is the receivables period from the table data, payables period, holding period. So, all three things, if we can calculate, and then based on that we would be able to calculate what is the cash operating cycle. And then a couple of other questions are also asked. Of course we've done this in the class, but since you have mentioned that you were not present there, so let's take it up, the same thing. See, receivables period is 365 days into, so the denominator receivables turnover ratio, whatever is there, it gets reversed, and then we would have it as receivables divided by credit sales. See, multiple things are given in terms of sales. Credit sales are given, cash sales are given, but then whenever we talk about receivables, with specific reference to receivables, it's always the credit sales. Just substitute the values into this one, into the formula, and then arrive at that. Please work it out in your note simultaneously, so to verify whether this particular thing is right or not, um, so that you will also have some amount of clarity. Receivables period is equal to 365 into receivables by credit sales. Srinivas asked me to do working capital management questions from that. So I am working out questions on that. Others, those have joined, Tehniyat Ali and Niranjan. If you have any doubts which you want me to clarify, please let me know the topic so that we can take it up after this working capital management.
Yes, ma'am.
So put it in the chat box, whatever is your topic, we can take it up. Okay, the next one is payables period, also in a similar fashion. So when we talk about payables, we need to focus on, see, there are two different types of payables. One is trade payables and other payables. Other payables on account of certain other transactions, but trade is with respect to the main activity, operating activity, which is buying and selling. So we need to be focused on what is the amount of trade payables alone. Okay, Niranjan, after this we will take it up. um, then The next one is inventory holding period. So take it up. What is inventory holding period? So 365 days into average inventory divided by cost of sales. Since we have both the beginning inventory and the ending inventory, okay, so um, we can find out what's the average inventory. See, inventory holding period is equal to 365 days plus 365 days into inventory divided by cost of sales. The logic about why are we to take cost of sales instead of sales is the all turnover ratios, the concept of turnover is sales, but turnover again changes with whatever is the specific item. If it is receivables, the turnover would become credit sales. If it is payable, turnover becomes credit purchases. Such information is already provided to us, which is credit sales and credit purchases. But with reference to inventory turnover ratio, turnover means cost of goods sold. The reason is turnover is always valued at cost and sales is valued at sales is cost plus profit. There is a higher value included in the sales value on account of profit. So what are we to do that? Eliminate that profit margin and then focus only on the cost of those units that are sold, cost of goods sold. We also know the formula for cost of goods sold, which is opening stock plus purchases minus closing stock. The data is all provided to us. We have the opening stock, we have the closing stock, we also have the purchases value. This is opening stock. The total purchases are given to us 212,000 plus 21,000 minus the closing stock. This one. So we arrive at what is cost of goods sold. Yes, 10 years we'll do it. Okay, so after that, take it up. Find out what is inventory holding period. So we have the receivables period as 65 days. We have the payables period as 52 days. Srinivas, I hope you have done the calculation. And now we have the inventory holding period. What is the receivables period from the table data? What is the payables period from the table data? What is the inventory holding period? So inventory holding period, we have calculated inventory holding period to be as 84 days. For cycle X, what is cash operating cycle? What is cycle X? The question further continues. So there's some data, some financial data which is provided to us related to the current assets and current liabilities. So from the table data, whatever is asked was calculated. So are we to calculate cash operating cycle from the table data? No. It again talks about for a specific cycle X. So what is the cycle X? In the question, we have some data given for cycle X. In one typical cycle of trade, that is in cycle X, there are some details that are given. Goods were ordered on 17/1/15 and delivered 21 days later. The supplier was paid on 25/2/15. The goods remained in inventory for 62 days. At which point these goods were sold on credit terms of 60 days. Grumpy was eventually paid 68 days from the sale. 68 days after the sale was made. Assume there are 365 days in a year. This cycle X, the details are given. Some of the terms are given, some of the details are given already calculated. Others, we need to look into that. Cash operating cycle is the sum total of the inventory days plus receivables days minus payable days. So if we look into that, the goods remained in inventory for 62 days. So in inventory holding period. So the inventory was held by the business for 62 days. Then at which point these goods were sold on credit terms. Credit terms, it talks about the receivables part. Grumpy was eventually paid 68 days. So the thing is, they have sold the goods, and also extended. Immediately as soon as the sales were made, cash was not collected, but rather they have collected some 68 days after the sale was made. Assume there are 365 days in a year. So in this particular case, what is that we are to do this one? So receivables period that is given to them is 68 days. Grumpy was eventually paid 68 days. There would be a doubt about, see, from the day when the order is placed, that we should be considering. No, the realization concept says that the day when the ownership right is transferred, or the goods are delivered to the customer, irrespective of whether cash was paid or not, is the day of realization. So from the date of realization, so then they have extended a period of 68 days. So 68 days is the receivables period, receivables days. Then payables days. Payables days, let's once again read through the data. For cycle X, goods were ordered on 17/1. See, the day of ordering is not important. That would not be counted. But the date will be counted from the time the goods are actually delivered. The way we see here in case of receivables also. Receivables, Grumpy was eventually paid 68 days after the sale. So it took 68 days for them to pay from the day the goods were delivered. So also at the time of purchase of material from the suppliers, orders were placed on 17/1/15, but 17/1/15 is not important. Realization concept says that when the goods are actually exchanged, the goods were delivered, the ownership rights of that particular transaction transfers. That's the date of realization, and the goods were delivered 21 days later. So the count will start from this date onwards. If we are to find out about the payables days, this date, though there is a date given, this would become irrelevant. So when would it start? It start after 21 days, because that is the day when the goods were delivered. So we need to actually, I mean, specifically arrive at that particular date. When does that 21 days, 21st day, on which date does it fall, has to be first calculated. So we did do that. From the date the supplier was paid on 25 to 15. So when we calculate 21 days, after that it comes to 7 to 15. 7 to 15 to 25 to 15 comes out to be 18 days. That's the only important focus what we have to remember. It is all about realization concept. So we then substitute this in the equation, cash operating cycle, and then arrive at what is the answer. I hope this adjustment is clear. After that, indicate by clicking in the relevant boxes whether the following statements about a cash operating cycle are true or false. A long operating cycle is more serious in a period of strong growth. Operating cycles tend to be longer in brand new businesses compared to established businesses. See, from the answers, we understand that both of them are true. What does it mean? See, a long operating cycle is more serious in a period of strong growth. Very frequently they will have to be investing into the cycle, because more customers are attracted, more is the activity. So they cannot be held short of cash availability. If it takes a longer period of time for them to collect the cash amounts, then in that case they would not be able to invest into the growth aspect of it. So it is considered as more serious in a period of strong growth. Strong growth, quickly the cash should be available, cash should flow into the business. With that, they take up again additional activity, again purchase additional raw material. So the cycle should happen very quickly. Cash should flow back into the business as early as possible. With that, they can think about expansion things. So one is true. Second one is operating cycles tend to be longer in brand new businesses compared to established businesses. Okay, tend to be longer. New businesses, to attract their customers, they have to attract them through certain strategies. One of them is a credit policy that is extended. So that is how customers can be attracted. So they need to wait for a longer period of time. So that's the concept of it. When we go back to our PPT, so if the operating cycle questions are done like that, very specifically, we also need to focus on specific items of working capital. First, in this case, is inventory. The inventory, how to discuss about inventory? Inventory, to manage this inventory, what has to be taken up? Basically, in a year, annual requirement of material is the total cost of material which would be purchased. See, but then uh, would they purchase the total requirement of material in one go? Let's say we go with that assumption that if, let's assume that if it is 50,000 units of material which is required in a year, very basic example. So if they purchase all 50,000 units in one go and store it, so they will have to spend lot of cost on storing this material which is consumed gradually throughout the year. Storage cost would be very high. Investing so much amount into buying 50,000 units will block their capital. They have to keep on paying the cost of capital on that, etc. So there are certain costs of holding the inventory for such long period, they would be very high. Instead, if they think about purchasing in smaller lots, let's say if it is 50,000, purchase in lots of 5,000. So if that is what is considered 5,000 small lots, if they purchase, they would purchase 10 times. So 10 times they have to place orders. So ordering cost would increase. Considering that, there is an equation called as economic order quantity, how many units should be ordered, which is economical in nature, which saves the cost. So that's the concept of it. So it is a balance between how many units they store at a time in the stores department and what are the minimum number of times they would place an order. Just remember the formula. There's nothing more theoretical about it, which has to be learned and remembered. So for the total quantity, the total requirement of material, which is denoted by D, annual demand. For this one, how many number of orders would be placed, and each time when there is an order placed, what is the cost per order? Divided by, in the denominator, we have the average cost of holding one unit for 1 year. Find out, use this one, and then arrive at what is the economic order quantity. So economic order quantity, there are, see, in terms of inventory, there are certain other aspects also which we have to focus on that. Let's say that this is the total demand per year on, this is the maximum requirement of quantity that would be purchased and maintained by the stores department. But as they consume this material, it keeps reducing. As it keeps reducing, we would see that um, there is a need for another order to be placed. They cannot afford to wait until the time this inventory level uh, touches zero number of units. See, if it touches zero number of units, production will be stopped, which would prove out to be quite expensive. See, when the activity is not going on, there are so many overheads like rents have to be paid, salaries have to be paid, no activity which is going on. It proves out to be very costly for them. For that reason, they do not wait until it touches zero, but before that itself they place an order, which we call it to be as a, suppose let's say this is the point at which they are placing an order. We call this to be as a reorder point. So how do they decide what is reorder point? How many days does it require for them to receive the material? The number of days which is required for them to receive the material from the day the material is ordered, from the time order is placed till the time the material is received, is called as lead time. So during this lead time, let's say maybe it is 10 days. So during 10 days, how many units of material would be consumed during these 10 days would be taken into consideration. That's the focus. So 10 days into units required per day. So as much as that is still available with them, then they decide to place an order that is called as reorder point. But then again also, there's something called as, they do not count that from zero number of zero units till reorder point, but before that there is something called as a buffer stock or a safety stock. So there is a term which is given here as buffer or safety. So that's the least point which they would touch. Least is not zero, but some safety stock. They cannot afford to go anything below that. That's kind of a danger level for them. Okay, if it goes below the safety stock or the buffer stock, okay, it is not. It is something considered as a danger limit. So this would be the lead time during which they would require the material. So if buffer inventory is held, holding cost would be, see, the buffer inventory anyway it would be held plus whatever is the total quantity. The total quantity, they would not be calculating it on the total quantity of material, but the average quantity. Why would they calculate it on the average quantity? Is, see, inventory is not the same throughout every single day. Throughout the period, it is not the same, it is reducing. So, at what point is the inventory to be taken as inventory? Instead of that, it would be the beginning inventory plus the ending inventory divided by 2. So, average inventory into inventory holding cost, CH. CH is inventory cost of holding the inventory. So, that is how it would be considered if there is a safety stock or a buffer stock which is maintained. Just remember this equation about what is the cost of ordering quantity which is economical in nature. That is in terms of what is the cost which is ordered which is economical in nature. That's one point. Then theoretical aspect, because if there is a question focused on inventory management, they would also touch about other areas of inventory management. We see that inventory which is accounted for in the books of accounts could be done periodically or perpetually. So periodically is, see, at the end of maybe let's say 1 month or 1 week. So they verify how many units are remaining, what is the cost of that those units, that is calculated and accounted for, is called as periodic review. Some systems wherein after every single transaction they verify what is the balance of inventory which is available in the uh, stores department. So that is perpetually every transaction they verify what's the balance. Periodic review and perpetual review. See, JIT, by now you must have studied multiple times. You must have studied in MA, PM. JIT is, instead of holding material something like this and then keep on verifying what is when to place another order, etc. See, what is happening is when they purchase material beforehand, sorry, they are holding the inventory, and for holding the inventory they are paying holding costs. So that is what is seen. And for when the material is purchased and held by the business, the capital amount is invested into material, the working capital, the capital is invested into material until the operating cycle, cash operating cycle completes and cash is received. Capital is blocked on which cost of capital is paid. For that reason, to eliminate these costs like cost of holding inventory and the cost of capital, we see that there is a It's actually an innovative technique of inventory management, but we've been studying this for quite a long time. GIT system suggests that do not purchase anything beforehand, but wait until a time when the customer actually comes down with the order. Once the customer places an order, according to that, purchase the inventory and take up the production and deliver the goods to the customer. But then production is not such an instant affair, and purchasing material from the suppliers is also a time taking. That's why we are focusing on what is the lead time. How many days does it require? So these are two major issues. Production is not instant. Purchasing material from the supplier is also not instant. These are time taking processes. So for that reason, the suppliers with whom they would be placing orders, they would already enter into some agreements that whenever they require material, the supplier very reliably supplies the material instantly. So that kind of an understanding, the quality, the price, multiple aspects are already discussed with the supplier. This is another aspect also which we see that the production work also gets completed very quickly because the workers who are working in the factory in such a system, GIT system, would be multi-skilled and multi-talented workers. Everybody knows every type of work. They know how to operate the machines, etc. So in the absence of anyone, also they can still replace the others, and then production work can be completed as quickly as possible. Supply as early as possible, production completes as quickly as possible, and the goods are delivered. Amount is received from the customers, and they do not have to invest into inventory, no holding cost, no cost of capital, etc. That's how it works. You need to remember that because at least one bit of it is asked as theory. See, if there are 5 MCQs which are asked, one bit at least would arise as a theory. After that, if we are focusing on receivables, what's the basic aspect about receivables is it's a policy about selling goods on credit basis. See, on credit basis, if they are selling the goods, how much would be the credit period, or how many days of credit period will be extended to the customer is what has to be focused here. Now, that's a policy which has to be decided. So, since we have already looked into the cash operating cycle, if it is for a longer period, see, because of selling goods on credit basis, if the finished goods were sold here, if these sales were on cash basis, see, the operating cycle would end here itself, but this got extended because they sold it on credit basis. Okay, so their longer operating cycle is creating more problems for the business because whenever they require cash, then in that case, they may have to go to raise additional funds from other sources. That also involves interest. The cost has to be paid on that. So in this case, because of why are goods sold on credit basis again is the question, to attract them, to attract the customers to purchase the goods from them. For that reason, goods are sold on credit basis. That's all fine. But there is another strategy which is associated with this is motivating the customers to pay as early as possible. Motivating the customers to pay as early as possible is announcing a cash discount if they pay within a stipulated period of time. For example, if they have a credit policy of extending 30 days credit to the customers, but waiting for 30 long days for the cash to receive, it may be a problem for the business. So they want these payments to be received as early as possible, if that is the case. Now, then in that case, as early as possible is what if they are looking at. Maybe state something like as within 10 days, if they make the payment, they can avail a cash discount. So, what is that cost of discount is given by a formula. So, just have to learn about what is the formula about annual cost of discount, 1 plus discount percentage divided by the balance of the percentage of amount which has to be paid to the power of number of periods the entire equation minus 1. So how many number of periods? It depends on the total number of days in a year divided by number of days of that credit. See, if it is, let's say that the credit period is 30 days, out of that, um, 10 days, within 10 days, if they have to um, pay, so they're paying it 20 days earlier. 30 minus 10 is they're paying 20 days earlier. So that way it would be taken and find out what are the number of periods and then substitute in this one. We will be looking into one question now. Um, there are other aspects also. The receivables could be discounted with banks or financial institutions. See, the invoice, as soon as the credit sale happens, the invoice that is received by the seller can use this as a collateral to raise some amount. So the invoice is given to the banks or financial institutions as against the invoice, because invoice is the proof that that a sale has taken place, and on presenting the invoice only the customer will make the payment. So that is a proof that the transaction has taken place and the business has that as an current asset. So against that, some usually up to 80% of the invoice value amount is paid by the financial institution or the bank. So when they pay that, so as soon as the credit period ends, the customer will pay the amount. The customer will pay the amount to the company. So company will return back the amount to the financial institution or bank, adding some interest percentage, because this is a service provided at a cost which is the interest cost. Okay, so that is invoice discounting. Another theoretical aspect for this one is it is a financial service similar to this one, but the day when the payment becomes due, it is the factor. Here in this case, it's not the bank or the financial institution, but it is the factor who gives the amount to the company. Invoices with the factor. Factor presents this invoice to the customer to collect the amount directly from the customer. So when the factor collects the amount, he would collect the amount 100%. As of now, see, close to or about around 80% of the amount would be paid by the factor um, to the company. So the balance of 20%, whatever is there, which the factor has already collected from the um, customer, will be remitted by the factor after deducting his interest and any other kind of an administration charges. So this concept of it is debt factoring. Now, another important aspect which we need to remember here is who would bear the bad debts if at all if they arise in future? Would it be the company or the factor? So we see that the factoring could be without recourse and with recourse. That is, um, um, see, if the factor takes up the risk of bearing the bad debts, he would charge a higher percentage of administration charges because he is also ready to take up the risk of facing any kind of bad debts that arise. Other situations, we see that the factor would transfer them back to the seller, and the seller will only bear the bad debt losses. So that's a theoretical concept, because if we have a set of questions, one bit can also be about the theoretical aspect. So we need to learn about that. Now, in case of payables, we've learned about inventory, we've learned about receivables. Then we also have to focus about the accounts payable. So the same way, how do we address the issue of discount facilities? So what is the cost of availing the discount? The supplier this time may extend a discount to the business. So should this business be availed or not? Using the same formula, cost of discount, we can arrive at a decision about should that discount facility offered by the supplier, should it be accepted or not. That is about managing the payables. Another current asset is cash management. Cash management, if we are aware about what is the EOQ model, Applying the same model of EvoQ for cash management as well, we can find out what is the optimum amount of cash balance that would be maintained. Fine. Same thing to COD by CH. So using this formula, it can be arrived at what is the amount of cash balances that have to be maintained. Why is that this is important? The cash is never kept idle in the business. Cash has to be invested in some asset or the other, some activity or the other. The reason is cash kept idle does not give any kind of a return. Therefore, cash has to be invested into some activity. Then only it is possible to earn a return. So, focus is on profitability. But then again, if cash is not available, payments cannot be made. If payments are not made promptly on the due date, the goodwill of the business also gets affected. So that is again a serious issue there. Therefore, what is the right amount of cash balance that has to be maintained? We see that the total requirement of cash over a period of time, every time there is a transaction that is taken up to raise cash balances, like some funds have to be raised, so some transaction costs like brokerage commission etc whatever is paid, as many number of times they raise capital or they raise funds, that many number of times these transaction costs will be incurred. Then any amount of cash that is held which does not give a return also is costlier for the business, that is the cost of holding the cash. Done. So using the same formula, we would arrive at what is the cash requirement. This is called as Baumel's model. Just learn about the formula. See what is the concept explaining about it. There's another model which we call it as the Miller ORR model. So Miller ORR model talks about, see, there is an average amount of cash balance that has to be maintained. Fine. But cash is not a cash item is not something which is static in nature throughout the period same amount would be there is not the scenario, because as the operating cycle is taken up, sometimes we see cash is flowing out of the business, sometimes cash is flowing into the business, so there are fluctuations in terms of cash balances. So in this, according to this model, they have decided that, see, there should be a minimum level of cash balance that has to be maintained, has to be decided. The least requirement of cash is the minimum level. The maximum requirement of cash is the maximum level. Both of them would be decided. So when these two things are decided, minimum level and the maximum level, when these two things are decided, let's see, if you're talking about cash is flowing into the business, so cash flows are rising. How much cash should be maintained? They would put a lock on, say, as soon as it touches the maximum level, this is the maximum level, so take up an transaction, take up an activity as investing this into or into some activity, so drastically the cash balance falls down to that level of what is the return point or the average cash balance. Okay, then this is the amount of cash balance which is available. But as they proceed further, then we also see that there are situations where cash is flowing out. So when the cash is flowing out and the cash balances are falling down, now when the cash balances fall down to the least point, which is the minimum level, at this minimum point, when it touches the minimum level, since they already have certain investments made into current assets or some asset form, it is converted, some other asset form from cash to some other asset form which is converted, it would be liquidated, and then again the cash balance rises to the return point. So they liquidate this amount and then see that it comes back to the return point. We see that the fluctuations carry on that way. This is called the Miller ORR model. Now this is quantified with the help of an equation. What is that equation? How do we arrive at what is the return point? Return point is the lower limit. Lower limit is this one, the minimum level lower limit plus spread into one third. But what is spread? Spread says that there is a big formula given 3 into, we see that 3 by 4 into transaction cost into variance of cash flows, the entire thing divided by interest rate, and this part of it is cube root to the power of 1 by 3 cube root. Okay, so using these formulae, we would arrive at what is the amount of cash balance that has to be maintained at any given point, which is calculated by return point. Okay, then since you have already done a PM, in that you have learned about different types of budgets and the cash budget. Cash budget is once again tested here because with the help of cash budget also it is possible for us to understand what is the requirement of cash balances. So we will be looking into that. Okay, so here with reference to cash management, we see that there are three aspects: choosing short-term investments. So, if the amount is invested into short-term investment opportunities, one important thing is because they are investing into some investment opportunities, some profitability should be there, profit should be earned. They should also be able to convert it into cash. Liquidity is another aspect of it. Liquidity plus what is the percentage or what is the amount of risk that is present with this particular investment opportunity. These aspects should be focused on when cash management decisions are taken to invest it into short-term borrowings, investments and borrowings. Okay. Um, Financing working capital, see current assets, all of them are converted in a period of 1 year or operating cycle, whichever is longer. That part of it is anyway there. But among them also certain current assets are not very easily converted into cash. So we do not categorize them as quick assets or liquid assets, but rather we call them as permanent current assets. It gets converted in 1 year, but not very quickly. Maybe it takes all that 1 year time period. For that reason, it takes a longer period of time for them to convert that into cash. Okay. Here, financing working capital, um, if we are looking into a balance sheet, the on the liability side, we would have the on the liability side, we have the current liabilities, then we have the long-term liabilities plus the equity, which need not be repaid in a short period of time. Of course, equity is never repaid as long as the company exists. Long-term liabilities also have a longer period. So long-term liabilities, one second. So long-term liabilities and equity need not be repaid immediately. Then we have current assets on the asset side of the balance sheet, and then we have the fixed assets. Among the current assets also, we see that there are, if we categorize them, we see that there are permanent current assets and then there are fluctuating current assets. Permanent and fluctuating current assets. Maybe let's put this one as permanent and we'll make this one as fluctuating. See, as many as the current liabilities, double the amount of current assets would be there. So the current liabilities that are used should be used to invest it into fluctuating current assets because they get converted into cash very easily. This can be repaid. So the account settles there. But in case of fixed assets, long-term liabilities would be used. Long-term liabilities, that is long-term liabilities plus the equity. Also, for the permanent current assets also, the combination should be that this plus this should be invested with these type of funds. So that's another important point what we have to focus. Okay. Um, is that Srinivas?
Yes, ma'am.
Okay. So we will also see another a simple question about how to calculate the um, cost of discount. There is a simple question here. Swap company is due to receive goods costing 2,500. The terms of trade state that payment must be received within 3 months. However, a discount of 1.5% will be given for the payment within 1 month. Total credit period is 3 months, but within 1 month, if they pay, can avail a discount of 1.5%. So, what's the annual percentage of discount? So what's the cost of not availing the discount? Cost of availing the discount or not availing? How much would they be foregoing if they do not avail the discount? So substitution of the values in the formula. Formula we see that annual cost of discount is equal to, this is the formula. Percentage of discount given is 1.5%. If they avail 1.5% discount, they actually have to pay 100% minus 1.5, which is 98.5%. Amount left to pay 98.5%. Done. After that, how many number of periods? See, because the periods are mentioned in terms of number of months. In a year, there are 12 months. Out of 12 months, they are foregoing 2 months credit period. 3 months they can take and pay at the end of 3 months. But by availing discount, they would be paying 2 months before that. They're foregoing the benefit for 2 months. So divided by number of months earlier the money is received. They're foregoing that many number of days or number of months. So 12 months divided by 2 months is six periods. So substitute that and then arrive at the formula. Okay. I hope that's clear to you. In fact, actually there is an SC question we will be looking into. One second, I'll put the another question. Okay, there is one question here about the current assets and current liabilities. Let's focus on this particular thing. King Company is a decentralized organization whose different divisions have approached the matter of cash control in different ways, partly because of their different circumstances. Assume 365 days in a year. The Western Division is facing a 2-year major capital investment program for which significant funds need to be raised to meet the steady demand for cash. The division intends to use the Baumol model to decide when to raise funds, which will be done by selling off investments currently earning 5% per year. Okay. So how much cash is required? How much cash is required has to be assessed by Bauman's model. Decide when to raise funds, which will be done by selling off its investments earnings 5% per year. The transaction costs are given as 500 per transaction. The total demand during the 2 years period is 2 million. The Alpine division has no significant investment plans but finds itself regularly having to either sell investments to make funds available or invest surplus cash. So that would be according to the Miller ORR fund, ORR model. So if it touches the least bottom, the minimum level, uh, they would not allow the cash balances to go any below the minimum level. At that point of time, they would sell away whatever investments they have earlier made, which are short term in nature, which can provide solution to liquidity problems. So they sell away that, or if they have too much of surplus cash available with them, they immediately invest it into some short term investment opportunity. So the standard deviation is given as 7,000. Then we have the southern division has just been created to manufacture a product used by other divisions, but mainly sold to outside customers. The coming month one will be spent converting and equipping existing corporate premises at a total cash cost of 800,000. Production will start in month two and sales in month three. Then we have planned sales volumes are given as follows. Then the selling price is $24 per unit. 20% of sales are on cash basis. Credit sales, 25%. This is certain terms given. 25% of credit customers pay in the month following the sale. 50% will pay 1 month later, and 25% after another month. So there are certain questions. So this is King Company. We have read through the questions. Let's take up the answers for this one. The answers for this one is first bit says how much finance should the Western Division raise in a single tranche according to Baumel's model. Baumel's model under root 2 COD divided by CH is the formula. We have learned from the data that the cost of each transaction is the total requirement is 2 million, cost of 2 million for 2 years, cost per transaction is $500, and this is which will be done by selling of investments currently earning 5% per annum. So substitute the data in the formula. 2 COD divided by CH. The entire fraction is under root. Find out that. So we see that 2 into CO is 500 into the requirement for 2 years is 2 million. 1 year will be 1 million divided by 5%. And then find out what is the cash requirement during the year. B bit says find out what does the Miller ORR model suggest is the spread between the upper and the lower limits of cash levels that the Alpine division should maintain. According to Miller ORR model, the formula is what is the amount of cash balance which has to be maintained is the return point. On an average, return point is the value which has to be calculated. But return point is given as lower limit plus 1/3 of the spread. But what is spread? Spread is, there's a big formula there. So let's just find out what are the details. Okay. Transaction cost is 500. Already we know there. that we wrote it as C0, which is transaction cost is 500. Variance, the formula has variance, but the question has standard deviation of 700. What's the relationship between standard deviation and variance? Standard deviation is equal to variance square. Variance is equal to root of standard deviation. Formula has variance, so let's find out what is variance from standard deviation. That is 700 square. Okay. Yeah. Yes, ma'am. If voice is coming, whoever raised the voice is coming very low. Please raise your doubt. Okay, no problem. So find out the variance. Standard deviation is 7,000. I'll put it here. Standard deviation is 7,000. So 7,000 square is 49 million. Interest rate. Next variable is interest rate. What's the interest rate? Interest rate prevailing is Bowman model to decide when to raise funds, which will be done by selling of investments currently earning 5% interest per annum. 5% interest per annum, which has to be calculated per day, because we are talking about when it would rise, when would it fall. So that part, if we are looking into that, so just convert that into number of days. 5% divided by 365, we got some value. Substitute the values in the equation of spread. Spread is equal to 3 into, so there's a one whole long calculation which is under cube root. Use your calculator and work it out, and this is the answer. And substitute that in spread, and spread comes out to be this one. After that, in fact, actually this file is circulated in the classroom. This Excel file is there. Excel file, I mean the solution otherwise also is there in exam kit. But how did we work it out? The calculation calculations are there in the formula bar. You can see that, and then I mean verify and do the calculations. So this file is there. Two students have this file with them. It is being in circulation. You can please get it from any one of them and then look into the formula part. Okay, the question says, what does the Miller ORR model suggest is the spread? We only are asked to calculate spread. If we were asked to calculate the return point, the least amount minimum lower limit, 1 second. Okay, so we would substitute in this formula and find out. See, it says that what will be the southern division's cash receipts from sales in month 5. The terms and conditions have to be very clearly looked into for the cash budget. See, cash budget, the number of units that are sold in each month, starting from month 3 till month 7, are given to us. Goods are sold on cash basis as well as credit basis. 20% of the goods are sold on cash basis, 80% of the goods are sold on credit basis. That's one aspect of it. So the credit cash anyway will be received immediately, but the credit sales that are sold, see, they are spread over a different time periods. Of the credit sales, which is 80% of the total sales, 25% pay in the month following the, so next month. So 1 month later, let's put it as 1 month later. That's 25% of them would pay. After that, the 50% will pay 1 month after that, 1 month later. So this they will take 2 months here from the date of sale, and the balance of it, which is 25% of them, will pay after another month, 3 months. So altogether, see, the credit period is extended for a time period of 3 months. Credit period is extended for a time period of 3 months. Then cash sale anyway is there. So that cash sale part of it is anyway there. 1%, that is 20% of that would be. We are not asked to calculate what is the cash balance for each and every month of it. So only for one specific month, which is month 5, they have asked us to find out what's the cash balance. So cash receipts first 20% of the 5th month sale. So 20% of the 5th month sale, you can look into the formula bar. I am putting it here. See, formula bar says that 13,000 units which are sold in the 5th month, 13,000 units that are sold at $24 per unit into cash sales is 20%. So just calculate how much cash is received in the 5th month on account of cash sale. Then now comes on account of credit sales. The time period is total of 3 months, which we have presented here already. 1 month, 1 month later, 2 months later, 3 months later. So credit period is covering a total period of 3 months. See, this would be, see, if, I mean, when would they be collected? 3 months, the next 3 months, 1 month portion. But how much would be collected will be from the sales that were happened in the previous months. From there, we pick them up and then we bring it to the present month, which is the 5th month here. So focusing on that 3 months period, okay, then we would present it as the credit sales. Credit sales are the question here. See, the question here was not properly framed. Here it says that of the credit sale, 25% of credit customers pay in the month following the sale. Pay in the month following the sale is 1 month later, 2 months later, 3 months later. But their intention, that particular framing of the question was not appropriate. So we see that if we talk about 5th month sale, 5th month sale out of the credit sales, here this is 5th month sales. We are doing it for the 5th month only. 5th month sales, only the cash sale will be received. Credit sale will be received in the 6th month, 1 month later, one portion in the 7th month, one portion in the 8th month. So nothing would be collected from the credit sales of 5th month. Go to the previous month. 4th month, only cash sales will be received. Credit sales, one portion in the 5th month. What is that one portion? That one portion is 25%. 11,000 units are sold at 24 into 80% is the credit sales into 25% will be received. Third month, 1 month prior to that. The third month only cash sales will be received, credit sales out of that. One portion, 25% will be received in the fourth month. We are not bothered about fourth. We are bothered about the next 50% in the fifth month. So calculate that and add them up is what's the total cash receipts during the month or during the fifth month. Okay. That's how we calculate the cash budget. Debit. It is important to distinguish between a cash budget and a cash forecast. What is the validity of the following statements? Statement A says, a cash forecast is an estimate. Forecast is an estimate of cash receipts and cash payments for a future period under existing conditions. But before taking account of possible actions to modify cash flows, raise new capital or invest surplus funds. Okay, that's about the cash forecast. A cash budget is a commitment to a plan for cash receipts and payments for the future period. After taking any action necessary to bring the preliminary cash forecast into conformity with all the overall plan of the businesses. So both the statements are correct. Please look into the content. Both of them are correct. Then EBIT. Which of the following is not an advantage to King Company of having a centralized treasury function? Centralized treasury function is about management of funds. So they look into how funds should be raised, how funds should be managed, etc. It says that better foreign currency risk management, borrowing can be made at more advantageous rates, increases individual divisions' responsibility for cash. The treasury function can be run as a profit center to raise additional profits. Okay, not an advantage. So something like we are talking about a disadvantage, not an advantage of is mentioned here. See, with the treasury function, centralized treasury function will better manage the risk, currency risk management. Borrowing can be made at more advantageous rates. Right time they can borrow. Something can be done with that. Increases individual divisions responsibility for cash. Third one, treasury function can be run as a profit center to raise. They are part of the organization, not an individual unit. Okay. So then here treasury function is a unit of the organization. It is not about individual divisions responsibility for cash. That's that which of the following is a not an advantage, it's a disadvantage. Okay, increases individual divisions responsibility for cash. Okay, so that will be taken as a disadvantage here. See, I did cover certain other questions also in the class. Jeeps company was done, etc. So certain other 2-3 questions also. Please look into the Excel file and then verify. Try to follow this one because other students are also there with the other doubts. So I will take it up. Someone else is there in the class about appraisals. We will take up a question or two on appraisals. I want you to, Srinivas, I want you to follow the Excel file and then do that. Still, of
Okay.
course, still, of course, you may have other doubts also arising. So in that case, I'm leaving my number here. That's my WhatsApp number. You can put your doubts